Some of the best performing stocks over the past decade had one thing in common: a consistently high return on equity, ROE. Fund managers and seasoned investors often swear by this metric, and for good reason. It shows how efficiently a company turns shareholders' money into profits. So higher the return on equity, the better it is. Think of it as a report card for efficiency. But what if I tell you that even a high ROE can sometimes mislead you? Hello and welcome to our channel 5-Minute Finance by ET Money, where we discuss the basics of investing and personal finance. In this video, we'll see if the return on equity, ROE, is really the secret sauce for finding multi-baggers. Those stocks that grow your wealth multiple times, 10x or more. Can we say that stocks with high ROE always make you money? So let's understand the concept and the use case of ROE with simple explanations and real examples. Let's begin with what ROE is. ROE stands for return on equity. It tells you how efficiently a company is using its shareholders' money to make profits. The formula is simple: net profit divided by shareholders' equity. Net profit is the company's earnings after all expenses. Shareholders' equity is the money investors have invested in the company. Let's break it down with a small example. Imagine your friend Ravi opens a pizza shop in Mumbai. You invest 1 lakh rupees to help him get started. That's his equity. A year later, the business earns 5,000 in profit. Now ROE is 5,000 divided by 1 lakh. That comes out to be 5%. That means the business generated 5 rupees in profit for every 100 rupees of your money. But why does ROE matter? ROE is a big deal because it tells you if a company can grow without always asking for more money. Let's go back to Ravi's pizza shop. Now let's dream bigger. Say Ravi's pizza chain has 100 crore in equity. Equity means money invested by investors. And he earns a 20% ROE. That means it earns 20 crore profit in a year. If Ravi puts that profit back into the business, the equity grows to 120 crore. Next year, with 20% ROE, it earns 24 crores, and so on. See how it snowballs? That's the power of compounding at a consistent ROE. So ROE isn't just a one-time metric. It tells you how fast a company can grow its value if it keeps reinvesting profitably. So higher the ROE, the better it is. But can a high ROE guarantee high returns always? Let's look at the data. High return on equity sounds exciting, right? You might think I'll just buy high ROE stocks and wait for them to skyrocket. But hold on, it's not that simple. We analyzed 10 years of BSE 500 companies and found a surprising trend. Several companies had 20% plus ROE, but their stock returns were lower than even fixed deposits. Have a look at the table. You'll see big names like Castrol, Gillette and ITC. All had strong ROE but weak stock returns. If ROE is so awesome, why didn't these stocks skyrocket? Let's understand. High ROE isn't a sure win. They can be misleading. Why? There are two factors worth highlighting. Number one, overpaying, expensive valuation at entry. Imagine a vada pav worth 10 rupees being sold for 50 rupees just because it's from a fancy shop. Sounds unfair, right? That's what happens when we chase great companies but you pay too much. If a company's ROE is amazing, people might pay way too much for its share. Take Castrol India. It had a fantastic ROE over 60%, but the stock was priced at 52 times earnings. Later, when growth slowed, the valuation dropped to 21 times. And so did the stock price. A high ROE cannot protect you if the stock is overpriced when you enter. Number two, average ROE hides a falling trend. A company might show a strong 10-year average ROE, but is it rising or falling? Let's look at companies like Dabur and Hero MotoCorp. Their ROE has steadily declined over the years. So even if the average ROE looks good, a downward trend is a red flag. Always check if the ROE is stable or dropping. So now you know high ROE is not always a green flag. Sometimes it's overvaluation. Other times it's a declining trend over the long term. Also, the metric ROE does not work equally well in every sector. ROE doesn't work the same everywhere. It works well for sectors like FMCG and IT, as these businesses need relatively low capital to generate profits. But in capital heavy sectors like infrastructure, telecom or aviation, ROE can be misleading. Why? Because these companies take a lot of debt to grow. ROE only considers shareholder equity, not debt. So if profits grow by taking loans, ROE looks high, but that doesn't mean the business is efficient. Let's revisit our pizza shop example. You invest 1 lakh in your friend Ravi's pizza shop. He earns 5,000 profit. So ROE comes 5%. Now Ravi takes a 2 lakh rupees loan and earns 15,000 profit. Your investment is still 1 lakh rupees. New ROE becomes 15,000 divided by 1 lakh. That comes out to be 15%. Looks great, right? But the growth came from borrowing, not improved efficiency. That's the problem in capital heavy industries. ROE gets inflated due to debt. So what should you do? You look at ROCE, return on capital employed. It tells you how well the business uses all capital, not just equity. The formula for ROCE is EBIT divided by equity plus debt. Here EBIT, EBIT means earnings before interest and taxes. And in our example, EBIT was 15,000 rupees. Total capital was 3 lakh rupees, 1 lakh equity and 2 lakh loan. ROCE is 15,000 divided by 3 lakh. That comes out to be 5%. So while ROE jumped to 15%, ROCE stayed flat at 5%. That's why serious investors look at both ROE and ROCE, especially in debt-heavy sectors. So now we have seen ROE can sometimes be misleading, especially if debt is high or the business is in a capital-heavy sector. But when used correctly, ROE is still one good metric to judge business quality. A high ROE builds wealth only if it consistently grows, is backed by profit growth, and is not inflated by debt or one-time gains. So keep these things in mind. Take a look at the table on your screen. Here are some companies with high ROE that actually delivered great returns. Don't read them as our recommendations. You can use them as a starting point of your research. And it's a wrap. Hope this video helps you understand why high ROE stocks may not always be the multi-baggers and what is the right way to use this metric to evaluate a stock. So have you ever invested in a high ROE stock that underperformed? Share your story in the comments below and don't forget to like and share this video. Happy investing!
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.